The purpose of the Global CFO Council is to provide an educational and networking forum for senior financial executives in order to share best practices, discuss current financial issues, and to learn about current topics related to the performance of their jobs.
Normally, my little shtick is that I find interesting things about people on the internet and then I share them and I show pictures and we have a good laugh. There's nothing on the internet about you.
There's something. There's some news stuff I've done, but other than that, there's nothing, no pictures.
Boring. Yeah, I don't want to, reveal that you were quoted in a business journal or you were on TV. I look for fun stuff like you won a drinking contest in college or something. But there, you are like radio silent, very professional. So I'll share the boring stuff I found. Mac Johnson is the Chief Investment Officer and Senior Economist at Pinnacle Financial Partners. I think you got your undergraduate at Southern Methodist University, I think in marketing. Is that correct?
Marketing economics, that's correct.
Marketing economics. And a master's in finance from Columbia University. And I think you live in the great state of Tennessee, maybe Nashville, Tennessee.
That's correct.
Well, I'm sure you're an awesome person and you've done awesome things, but I couldn't find any funny things on the internet. So my introduction is light, but that leaves time for your great presentation. So Mac, I'm going to mute myself and just keep an eye on that chat box for questions. You pause somewhere in the middle and I'll hit you with a couple, and then I'll hit you with a few more at the end.
That sounds great. Thank you very much. Glad you're all here. Let me start this presentation a little bit and go through. If you look at the current situation of where we are, there remains a lot of uncertainty despite the unprecedented support from Congress and the FOMC. The U.S. is coming off its third COVID-19 peak. There's currently 19 variants across the world. We've only had to really deal in the U.S. with Alpha, Delta, and Omicron. But I think there'll be another variant that comes our way by the end of the year, if you look at sort of the way the cycles run at this point. So that's something to watch out for, and that breeds uncertainty. And then currently the U.S. vaccination rate is about 76%. I think we're getting closer to herd immunity. Omicron really helped that. The veracity of the spread of that variant was very helpful, I think, in that regard, but you're not there yet. And then the last thing I'd say is fiscal support from Washington and the FOMC is ending, and that has implications for the growth rate of the economy as we move forward. This is the my current numbers on the GDP estimates. You can see the economy contracted 3.5% in 2020, was up 5.7% in 2021. It would have been up only 5.4% had it not be for the rapid growth in the fourth quarter of the 6.9% print. And I think Omicron will really hurt the economy in the first quarter, but I have the economy sort of growing out of it. But the momentum of the recovery is slowing, and there are a number of reasons for that. First and foremost, I would say the biggest reason is that the amount of fiscal stimulus, as I said, is running out, and the Fed is really moving from an accommodative stance to a much more aggressive stance to try to slow the economy down and slow inflation down, and I'll get to the details on that. I also think that growth, if you look at my 2022 estimate, I'm at the low end of the range. The Fed, at their December 15th meeting, said that growth would be this year be 4%. I think that's way too aggressive. The street numbers, if you look at street numbers, are generally arrayed between 2% and 3.6%. So I'm sort of at the lower end of that number. If I'm possibly surprised, that'd be great. I think the thing that would really positively surprise me would be if we had a pretty good inventory build in the second half of the year, which could create some disinflation and help the Fed with what they're doing. And then finally, I think if you look at the Fed's numbers currently for 2023, they're at 2.2%. I'm a little more optimistic. In 2024, they're at 2%. I'm 2.1. I do think you'll most likely have a recession between 2024 and 2026. Let me keep going here. This is unemployment rate, a 25-year outlook. If you went back to the 08-09 recession, the unemployment rate was 4.5% going into that recession. It took 7.5 years to get back down to that level. The unemployment rate going into the pandemic was at 3.5%. It peaked at 14.7 in April of 2020, and today we're at 4%. So it's essentially coming back down, and all the money that was spent and all the accommodation was very positive in creating enough jobs to move the momentum back down. But there's still more work to do, and I'll get there. This is my unemployment forecast. You can see unemployment rate in 2020 end of the year at 8.1%. I'm expecting to end this year around 4.1%. I think the big gains in unemployment have been made, and as the economy slows, I think it'll be very difficult for the unemployment rate to fall from here. And one of the reasons is labor participation. I'll get to that. And I also think the unemployment rate, if you're to look over the next 2 years, I think we're going to be flat to up a little bit. That I don't think there'll be really any more improvements there, and that's not good. If you look at labor participation going all the way back to 1947 in the U.S., you can see it peaked around 2000. We're at the lowest point in labor participation we've been since 1975, and so the whole value system of the checks that were being mailed out to people, with the $5.3 trillion of stimulus that was put out during COVID, basically it's sapped people's will to work, and the people that are working, they're changing jobs rapidly, and so you see a lot of turnover in hourly workers, and we'll get to that. But it's very discouraging to me that the unemployment rate, the participation rate, has fallen from almost 67% to 62%. And when you look further into unemployment, the trends are really not good, and I'll talk further about that later on. This is the money supply. This is the M2. You can see on the far right column that the M2 increased almost 40% when the Fed did their $4.8 trillion of quantitative easing. This is what's causing all the inflation. You've got a demand curve above the supply curve, so you've got rapid inflation. I don't think the Fed is going to be able to raise rates to really bring in inflation. I think if they raise rates 100 to 200 basis points, they do it. If they really wanted to stop inflation, they probably have to raise rates 5 to 10%. But I think in the situation you are now, they'll only be able to raise rates 100 to 150 basis points. If you look back at different recessions in the past and what's happened, generally corporate balance sheets weaken. The credit agencies downgrade corporate balance sheets, and also household balance sheets deteriorate. Home prices fall, like you can see that in 2008 and 9 with a hump here. But the good thing about this crisis is households have never been stronger. Their balance sheets have never been better. Their houses have never been worth more. Their 401ks have never been worth more. So this is a very positive omen for consumer spending, which is about 70% of GDP. And that's why my numbers, which might be low, I'm intentionally low at this point because I think first quarter will be very messy. And then I think things will build out from there, especially if you get an inventory build. This is the PPI forecast, producer prices. We ended last year with PPI around 7.4%. I do think inflation will moderate as the economy slows, and the economy was slowing due to a number of factors. The first is supply shortages, which have increased lead times from everything from furniture to appliances to cars. That probably took 2% out of GDP last year. The second thing that's going on is you've got high energy prices, which acts like a tax on consumers. And that high energy prices permeate all the food costs and all the raw material costs. And so you sort of have this Ukrainian event going on right now where it's very similar to what happened in 73, 75 with the Yom Kippur War. It's causing energy prices to spike, which will lead the PPI and CPI numbers for February, March to probably spike. But I think by the time we get to April or May, you'll see some calming down of these numbers. And that's what I'm really looking at. Again, you can see in January, year-over-year PPI was up 9.7%. Ex-food and energy, it was up 8.3%. Again, you've got Ukraine coming at the worst time. Here's my core PCE inflation numbers. I do think they'll continue to moderate. If you look at the current futures on where people in the derivatives market are betting, they think PCE will end the year around 2.6, 2.8%. I think that they'll continue to moderate. I think the FOMC tightening that we've talked about, and I'll get to further detail on that, will cause GDP to slow and inflation and demand for goods to slow. So this is sort of where we are. Inflation continues to run hotter than forecast. Consumer demand is above the supply curve and above 2019 levels. We continue to have a labor shortage. There's 3 million workers left their jobs in November. There are 11 million job openings. If you look just at trucking and distribution, there are 120,000 trucking jobs available. Raw material costs and component shortages continue to hurt the economy. And then failure of the Democrats to pass additional stimulus will further rein in growth as we move forward. And we'll shift a little bit and talk about interest rates and sort of what's going on with interest rates and what my view of the world is there. If you look at the yield curve and you look at where we were at the beginning of the year, the 10-year was at 1.51%. The ratio of the steepness of the yield curve from 2 to 10 years, if you look at that measure, was 78 basis points. Today, the 10-year is 195. The curve is flattened substantially. The 2 to 10 spread is 42 basis points. So you've got a Fed that's out there that shows that they're going to raise rates. If you look at the Fed fund future, 6 to 7 times this year. I don't know if they'll do 50 basis points at the March meeting or not. My gut sort of tells me it makes them look like they're further behind the curve. They'd rather do 25 and then do 50 at another meeting. But I think that what you're going for is you're going to have an inverted yield curve if they raise 4 or 5 times. And so at this point, that's very stimulative, not only for the banks, but also for the overall economy. And so I don't think they'll be able to get to 7 or 8 hikes. And I don't think the 10-year is really going to move a lot. If you look at what's going on with the 10-year, this is the 5-year view of the 10-year yield. We troughed back in during the pandemic, when the pandemic started, about 50 basis points on the 10-year. We're right at 2% today. Maybe the 10-year gets to 220 at the end of the year or early next year. But what's really happening is that the fact that the growth is slowing down, and if you look at what's really happening to the overall 2 to 10 spread, and you look at that over a historical period of time, as it approaches 0, basically it bodes that you're going to have a recession. And so what I see, you can see the recession in the gray bars. I'm pretty concerned at this point that if they were to raise 1.5%, that we'll have an inverted yield curve and we'll be in a recession by 2024. But let me stop there and see if Robert has any questions.
I do. I've got a bunch. I'll hit you with a few. Number one is just some definition questions. What is FOMC?
Federal Open Market Committee.
And what is inflation on forecast, PPI?
PPI is a producer price index.
We've got some questions around the national debt and rising interest rates. I'll just kind of combine them into one, Mac. What might happen? What are some potential outcomes of growing national debt in a raising interest rate environment? What might that do to the U.S. or other economies?
Well, I've got a chart. I'll skip forward a little bit to show you this chart just because we're talking about the question. But this is U.S. government debt as a percentage of GDP since 1965. And you can see that we're just under 138% at the first of the year, and it's starting to come down because you really have spent all this, you've allocated all this fiscal spending. You spent about 70% of it, but there's no more money coming out of the spigot. And so the Democrats failed to also raise tax rates. So this number will slowly come down, but on a historical basis, it's the highest it's been since World War II. So I think when you look at high deficits, if you look at the Southern European countries, Spain, Italy, Portugal, Greece, they all have very high deficits. They have deficits 400 to 500 times GDP. We're running at 130%. I think growth slows. I think this is a drag on future growth. I think when Biden runs for re-election, or if he runs for re-election, I think at the end of the day, one of the questions will be asked is, should we have spent $10 trillion on COVID when a lot of countries were able to spend $3 to $5 trillion on COVID and get the same results? And then if you look individually at the bills, I don't want to get too deep here. Here are the different bills. I mean, the COVID, some of the last COVID, the $1.9 trillion COVID relief bill that the Biden administration put through, only 10% of that was COVID related. There was lots of other stuff in it, that social spending that had nothing to do with COVID-19. And so I think that you'll look back on this, as I said, $5.3 billion you've spent in fiscal spending, and wish maybe you've done something differently during the pandemic years or reined in spending. But the go big, go home, I think will really hurt the economy and will hurt growth, not only over the next 5 years, but over the next 10 years. And it'll take decades to get that number back down, if that helps. Let me go back to where we were.
Mac, speaking of rising interest rates and our corporate debt, or being a senior financial executive at a company, I'm thinking as I read this question, there's probably a decent number of CFOs, maybe first-time CFOs, that have never been in their position during a raising rate
Right.
environment. What are your thoughts or lessons learned, things for senior financial executives to keep an eye out for in this environment as they
Well, I mean,
manage corporate debt?
first thing I would say is if they haven't refinanced all their debt over the last 2 years, they really missed the boat because generally companies have refinanced all their long-term debt and saved a lot of money, which has been accretive, which is why S&P profits are at an all-time high also. So that's the first thing I would tell them they need to do. But, I think at this point in the curve, you sort of have to have the capital structure set. Um, if it, it's going to, I'm assuming most companies are going to have floating and fixed debt. I mean, the floating desk is a risk, but I don't think it's that big a risk because a normal FOMC tightening cycle is 300 basis points, and I don't think you're really going to get more than 150, 175 basis points in this cycle. I think the flatness of the curve and the weakness of the growth will dictate that the Fed won't really be able to normalize their balance sheet either by raising Fed funds or by doing quantitative tightening, letting the bonds roll off. That was a roundabout way to answer that.
Perfect. And speaking of labor participation, a two-parter. One is, that I'll start with is the labor participation, is it younger people not starting to work? Is it older people retiring early? What have you seen within those numbers?
Well, if you look, I guess overall, there's an underemployment rate that's around 10% that I don't have in this presentation. So you have people that are, generally when you have a recession, people leave the workforce. And a lot of people left the workforce, I think, when COVID hit. Some people that are at risk, have health conditions, left the workforce. And a lot of them, people, sat on the sofa and they got checks and got bailed out for 18 months. But now that that's over, I think it's going to be harder for these people to get back into the workforce. Even though there's help wanted signs at every restaurant and every white bar and whatever kind of hospitality business you look at, I think it's going to be very difficult. Those people don't like those jobs. They only work there because they have to. And I think eventually when they run out of money, they'll go back to work, but they're going to drag their feet to go back to work because they don't enjoy their lifestyle. Sorry to say it that way, but I mean, those are people who work out of necessity, not out of because they think it's a good idea.
Couple questions around, and some statements with exclamation points, if I'm being honest, around money supply and quote unquote transitory inflation. It's something we heard this time last year that the inflation we're experiencing is transitory. Why were people saying that when that was in complete opposition to every textbook we ever had when we were kids?
Well, I think when you look at Janet Yellen, she's a perennial dove. She has been dovish. She's always going to be dovish. She has breakfast with Jay Powell once a week, just as Moody's can have breakfast with Jay Powell once a week. I think the policy, the transitory comment, I think came out of the Treasury. And I think once the Biden administration tried to put all these other candidates in front of Jay Powell, I think at this point he doesn't owe Biden anything and he will raise rates and do what he thinks fit, which is totally different than what he did in his first term. So I think that the reason inflation is not transitory at this point is the single biggest thing. If you could have a correction in energy prices, if oil could go from $95 or $97 to $50, that would solve a lot of the ills. And as growth slows, I think we'll get there on oil, but there's some structural issues in energy that where there's less drilling. You've got what I call a global expansion where the whole rest of the world is expanding and consumption's rising. And so there's some structural issues in energy that'll take it longer to roll over.
What do you see as the terminal rate from the Fed?
As I said, typically they would raise 300 basis points in a typical cycle. I think if they'll raise 150, 200, I see a Fed funds rate like 150 basis points or something like that, and an inverted yield curve. And let me say another thing. If you look at the 9 different times since World War II that there's been tightening cycles by the Fed. 6 of those times, the Fed cut rates within 12 to 18 months after they were raising rates. And I think in this scenario, if they over tighten, and over tightening might be over 125 or 150 basis points, they'll be cutting rates in 24 and 25.
The questions are just piling in. I'm going to give you 2 more just because you're answering them so well and so quickly. And then I'll hold the rest, everyone. Keep typing them. Back to a slide you spoke about net worth totals and that increasing. Is there any bifurcation? Household net worth. Is there any bifurcation within that number that it's rising, but maybe rising more for some, less for others, or is everybody rising? What's the story behind the details?
The real story behind the details is following the 07, 08 recession. Basically, in real terms, you haven't really kept up with GDP with building single-family houses. There's a shortage nationally of single-family housing. And so in areas like the Southeast, which include Charleston, Nashville, Charlotte, all these markets, you've got lots of population growth. People are leaving the Northeast and the upper Midwest for these states. They're generally at-work states with no income taxes. And as they move there, home prices are going straight up, inventory is going straight down. I've got a chart on that later. I don't think the rise in home prices is sustainable. You've got affordability issues where the mortgage rate as the 10-year rises. People won't be able to afford these houses. Plus, I think at some point builders are going to get caught with building a house for $500 or $600 a square foot. They won't be able to sell it for that at some point in the cycle. And so I'll talk about that later in the presentation.
And then a question around the unemployment rate. You spoke about that. The question is around they have offices in multi-states, and in some states it's kind of twice the average, and in some states it's half the average. Any drivers of that variance of the unemployment rate between the states within the U.S.?
Well, I think if you look at I think the same thing holds. If you look at work, the 7 states that have no income tax that are at work, they grow it generally twice the average, not only from a population, but from a GDP standpoint, than the states with the highest state income taxes. And those states would be like New York, New Jersey, Connecticut, Michigan, California. And generally those states all shed people are immigrating out of those states. Illinois would be in there too, where you've got lots of population falling, and they're trying to raise taxes on a smaller base, and it's sort of a toxic combination.
Mac, this is awesome. I'm going to mute myself and hold the questions that I get until the end.
All right, sounds great. I'm going to go back to slide 15, where I continue to think if the Fed inverts the yield curve, which you can see, this is a spread between the 2 to 10 Treasury on a longitudinal basis going back to 1975, that I think we'll most likely have a recession. If you look at what the Fed's doing with their QE purchases, they're purchasing $120 billion a month, 80 billion of Treasuries, 40 billion of mortgage backs. It behooves me why the Fed would still be buying mortgage backs in December and January when home prices are at all-time high and inventories are at all-time lows, which we'll get to that. They'll cease those purchases by March, and at the March 16th meeting, and they will raise the Fed funds rates, I think, by 25 basis points. I think expect them to raise the Fed funds rate 100 to 125 basis points this year. If they go faster, I think they get to 150. I think, again, the yield curve will be inverted. I don't think they'll be able to normalize not only their Fed funds rates or their balance sheet, which will limit the number of arrows they have in the quiver to fight another recession whenever it comes. And then without further fiscal stimulus, GDP growth will stall, as I've said, in 24 to 26. Now, I went through the fiscal spending that's happened. There's about 5.3 billion, of fiscal spending. There's $5 trillion, of fiscal spending that took place from Congress. There's also, if you were to look at the Fed FOMC's balance sheet, starting in 2008, you had QE1. Then you had QE2 in 2014, and then you could see in 2020, they've added an additional $4.8 trillion of bonds to their balance sheet. So their balance sheet today is just under $9 trillion. I don't think they'll be able to normalize this balance sheet. If you look at the maturity schedule of this balance sheet, less than 10% of the bonds mature within 1 year. I think it'll be very interesting to see how many of those bonds they can actually release and take down the money supply and lower bank reserves. I think the combination of them trying to raise rates and do some quantitative tightening is going to be very difficult, because I think growth will slow rapidly, as I've gone over before. Then here's the U.S. government debt as a percentage of GDP, again, an all-time high. It's coming down because you sort of had a bonfire of fiscal stimulus. The bonfire is essentially over. Most of the money's been spent. There is some infrastructure stuff and other money that will be spent over the next 8 to 10 years, but it's going to be small potatoes compared to what you had in 2020 and 2021. This is the Case-Shiller Home Price Index for the major 20 markets in the U.S. Again, you can see, prices were flat from 2016. They actually fell in 19 into 20 and have gone straight up. They're peaking as we think. I continue to think home prices will roll over at some point. And also the comment I made about home builders are building houses with more and more expensive raw materials every time. I have a friend who's building a house, just the lumber package for his house was 47% over the budget he had. So every stick of 2x4 that goes into the house, at some point, these prices won't be sustainable. If you look at home inventories going all the way back to 1980, you can see where home inventories are. Again, we sort of have a peak of home inventories, as I said earlier, in 2008 and 9, and then you've seen net inventory of homes continue to fall. And we just got us existing home sales last week, and they were down. And then the final thing that I would say that's the biggest disruption to everything that everybody's focused on are these supply disruptions. The U.S. has really gone from a just-in-time inventory system to a lean inventory system with expanded lead times on every single item. And the higher energy and commodity prices have exponentially risen the cost of shipping, cost of air, truck, rail, all these are rising rapidly. And there continues to be intermodal equipment shortages, not only of containers, but intermodal trailers and truck driver deficits. And then finally, the labor shortage driven by COVID-19 continues to disrupt and cause consumer product shortages at distribution centers. And like here in Nashville, we've got Kroger. Kroger is rotating crews to stock stores. So you can visit a store with nothing on the shelf and come back the next day and everything will be on the shelf. And so they're having a hard time sort of getting all the stock in and getting it stocked. If you were to look at like car sales, just to use this, these are U.S. car sales. Again, you can see that when COVID started, car sales fell almost 30%. In 2021, they shipped 30% less cars, but the automakers basically maintained profits by changing their mix to only high-end vehicles with higher margins. I do think if we get this, I do think that the semiconductor shortages are starting to improve, and I'll have a couple of charts on shipping here at the end. I also think that the auto inventories will probably take 2 years to get those inventories back on the lot. But I think there's been a sort of market change. Ford, for instance, is telling their customers, why don't you order the car versus us having 5 cars on the lot for you to choose from. I think that will be popular, and because a lot of people like to order their own cars and customize them the way they want. If you look at what happened with the German automakers, they lost over $210 billion in revenue last year just from not being able to have the components. I'm going to sort of switch into sort of what's going on with supply shortages. The two indexes here is the Baltic Dry Exchange, which is dry containers, and the Harpex Index, which is an index that takes into account weekly changes in shipping rates for all 8 types of container ships, the different sizes of container ships. You can see that all these indices have started to roll over on a shipping basis. And then I'm going to look at it from different routes. If you look at like Asia to the U.S., you can see rates have come down dramatically. U.S. to Asia rates have collapsed. Europe to U.S. rates didn't rise as much, but haven't gone down as much, and U.S. to European rates have collapsed. These charts run at about a 60-day lag, so I hope to get new data on these in late this month, early March, and I'll be able to update these charts. If you look at the subcomponents, the delivery times, you can see in blue the delivery times expanded. This is the lead times we see that sofas used to be 6 to 8 weeks. Now they might be 6 to 12 months. to order furniture, same with appliances and cars. You can see backlogs have risen, but they're starting to fall. And finally, purchase stocks or inventory are starting to rise. And the big thing I would say is if you look off the shore of Los Angeles or Long Beach, you'll see all these ships still sitting out there. They've been sitting out there for a month or two. I think once all that equipment and all that inventory is onboarded, you'll see a rise in inventory in the second half of the year, and I'll have to raise the numbers I have on GDP. But that'll be very helpful from an inflation standpoint when lead times collapse and people can get the stuff they've ordered. Then finally, here's a standard deviation from average value showing global supply chain. You can see we went, almost 4 standard deviations above the norm during the COVID crisis. This is a result of the $10 trillion liquidity, 4.8 trillion that the Fed did, and the 5 trillion that was fiscal stimulus. I think once that money dries up, you'll see this number come back down. And then finally, to summarize, I think the supply constraints will continue the second half of the year, and we hope that there'll be an inventory build. The demand curve continues to be of the supply curve. It's being exacerbated by oil prices. And then finally, fiscal withdrawal will cause some disinflation in the second half. I don't think that's widely out there. People don't talk about that. And then high global deficits, 300% of GDP, will drag down future growth. And then treasury yields will continue to rise above 2, but risk spreads will continue to widen as the economy slows. And that's all I've got.
All right, I'm going to hit you with some questions. And we got a few labor participation ones, so I'll hit you with those 3, and I'll kind of group them together. In a previous slide, you had labor participation. The historic low during the time frame presented was in, I think, the 50s at 60%. And what was the environment or the reason for that low participation rate? Oh, maybe it's 58 back then in the day.
Well, back in the 50s, you had, right after World War II, you had high inflation, and you had a lot of GIs coming home, and the U.S. had a very hard time restarting their economy into a civilian economy from wartime, which is one of the reasons that labor participation was so low. But once the economy started, really from the mid-60s on, the labor participation continued to expand as more and more people entered the workforce, if that makes sense. And then we've had 2 major recessions, one around a financial crisis and one around COVID. And both those, as I said, have dislocated some workers. They either have health issues or they don't want to work. And and the Fed has gone in and backstopped all these different crises. I don't think the Fed, if there's a major recession again, is going to come in and do a QE5. I think the Fed's in an all-in strategy right now, and that the safety net that everybody has felt over the last 2 recessions, I think won't be there if we have another recession.
How does the labor reporting handle what we call gig workers, the Uber, Lyft, or online sales via Etsy? How does it pick up that type of worker?
I don't know the answer to that. I mean, I think I don't know. I don't know. They're all independent contractors typically. I don't know how the unemployment benefits would pick up, how the employment system would pick that up.
Question around the unemployment, the unemployment and the jobs, the available jobs. So we've all seen the signs. There's everywhere is hiring, and it's around. Is a driver of this those that used to have second jobs but are no longer pursuing that second job because of maybe costs for dependent care or COVID related? It's just not worth it for that second job. Have you read anything about that having an impact in the labor market?
Well, not specifically, but I have read a lot of stuff about if you look at CPI and PCE. PCE is a Bureau of Economics index. CPI is a Department of Labor index. CPE captures wage inflation better than CPI does. If you look at those numbers, one of the reasons they've been rising so rapidly is that labor unit costs have been rising rapidly. And so within the hourly workers, there's a lot of people trading up. There are a lot of people that were stocking shelves at Walmart that have gone to a better job. And so the quit rate's very high. I don't have that chart in this package, but it's risen to the highest level since over the last 25 years. And so you've got a lot of people that are trying to become more upwardly mobile within these hourly workers. And unfortunately, the bottom end of that hourly worker strata is the one with the most vacancies and the least people that are willing to take those jobs.
Mac, you mentioned a little bit this in your presentation, but I still think this is a good question to kind of pull further details from you. If we're coming out of a season and moving into a season maybe with less or no quantitative easing, increasing interest rates, no or less stimulus money, does that increase the chance of some negative outcomes, some really significant negative outcomes in the economy? Is the current status quo just built on quicksand? Any concern? You put it in there about maybe something bad could happen, but how likely is the bad?
Well, when I say there's a dramatic slowdown in momentum of the economy. When you look at fourth quarter GDP comes in at 6.9%, and I'm estimating 1.7% for first quarter. So there's a dramatic slowdown in momentum in the economy. And some of that has to do with supply shortages, probably 2%. That cost you probably 2.5% last year. It probably cost you 1.5% this year. But the deficits, just the slowdown, the extension of lead times for all these appliances and durable goods is slowing things down. And so I'm pretty pessimistic on the first quarter GDP. I do have GDP numbers building. As I said, I'm a little below the street, but I think I'd rather be below the street than above the street. If you look historically at the Fed, I sort of mentioned their number for 4% this year. They've typically been high. They thought last year would be 7%. It came in at 5.7%. So they've typically been overly bullish on the numbers. So I don't really think there's something bad happening. I think this is a long expansion. You had a lot of fiscal stimulus that sort of pumped all the numbers and really got things going, and people started ordering cars and sofas and appliances. And I think all that's coming to an end, and the economy will slow, and the deficits will come a drag. Will become a drag on the economy versus helping pump the numbers like they did in 2021.
Mac, what are you seeing regarding wages? How are companies handling trying to attract new workers and retain existing workers in regards to maybe wages and benefits at the macro level?
I think wages are rising rapidly. I mean, you can look at the financial sector in New York. I mean, I happen to know like the bonus pools at Morgan Stanley, they were up like almost 30%. And I think people are willing to spend to keep the workers they have. And at the same time, the workers are enjoying more flexibility than they've ever had. COVID sort of, opened the barn so people will have more of a balanced workforce. And I think that's positive, not negative. But some companies are trying to force people back to work, and I think that's having mixed results. I think people enjoy the balance they achieved during COVID. But I think wages are rising rapidly, not only for hourly workers, but for salary workers also.
Mac, any data on how different countries handled the epidemic in different ways yet? Do we have any data, say, on countries like Sweden, which had less restrictions, or countries like the US or Australia, Germany, India, maybe that had greater restrictions? And
I think the restrictions,
if not yet, maybe when?
I would say that the shutdowns like you've got going on in China right now, this zero policy, is somewhat insane. I think you've got to allow people to live their lives and let them mitigate the risk. And so, yes, I mean, if you look like I do a state and local report for our different markets, not even looking at Sweden, but if you look at the difference between North Carolina and Tennessee on GDP, on unemployment rates, they had a much more conservative governor who put in much more conservative COVID policies, and you can see it in the numbers.
I'm going to pivot a little bit.
Okay.
But I think these some interesting questions. Any sort of macro economic update on China, since you just spoke about it? any reliable data that's coming out of China to
Well,
share or to look at?
well, they've got a very weak economy. They've been cutting rates. Um, it's generally an export economy with a domestic, you've got sort of an upswing in the middle class there. I think some of their policies, I think the zero policy on COVID, they're trying to crack down right now on Hong Kong because there's a lot of rampant COVID there and do testing. I think it'll be with mixed results. I think at the end of the day, it's a shame that the U.S. can't go to China and say, we'll cut the tariffs if we agree on these 7 things. But right now, there doesn't seem to be a lot of dialogue between the U.S. and China. And they're our greatest ally from a trading standpoint, but then our greatest enemy from other areas. And so if you could somehow cut through that and get to some agreement, and it's sort of a shame that Xi aligned with Putin on this Ukrainian thing. I think that sort of increases the complexity of it. But, I think their economy is very weak. They've been cutting rates. I think as our economy slows and our consumption slows, that will further hurt them.
Mac, if we put our 401k hat on as like an individual investor, or maybe as a senior financial executive looking to expand in other markets, any thoughts on emerging markets for us to look at, either as an investor or as a place to look to expand or find partners in any, whether it's a region, a continent, or a country? What are your thoughts on emerging markets?
Well, let me say a couple things. I think the S&P came into last year trading at 31 times earnings. Right now, we're 22 times earnings on the S&P 500. That's still expensive historically. Typically, the U.S. traded at 17 to 19 times earnings. Generally, emerging market stocks, generally Asia, Europe. Even if you look at Russia and all those countries, India, they're trading at lower P's than the U.S. But I would tell you that as the global economy slows down, they will also get hit, and typically emerging stock market get hit harder during slowdowns. And I own emerging markets. I also own some small caps. Small caps, if you were to go look at those indices, have been hit much harder than large caps due to the slowdown. There's an article on the cover of the Journal today talking about small businesses were struggling while large businesses were doing well. I think that U.S. stocks, U.S. large cap stocks are going to be vulnerable from a valuation standpoint, but you've got to own these other asset classes, especially because emerging markets is non-correlating along with municipal bonds to U.S. large cap stocks.
Mac, you mentioned what a benefit it would be if energy prices went down. This potential conflict in Ukraine might have the opposite effect. So what are your thoughts on that conflict in Ukraine and potential? I mean, there's a lot of hot spots around the world right now. What are your thoughts sort of on war and how it might impact this forecast that you just presented?
Well, I think if you look at it, it's much more dire from a European perspective. I mean, Russia produces about 10, 11% of the world's energy, and generally most of that energy flows into Western Europe. The largest user is Germany, and I think you've seen some reluctance from their prime minister to go along and cancel this North pipeline. I think if they do, they have announced they're going to cancel it. I think you'll see increased LNG shipments from the U.S. into Europe, but I think it's going to be an expensive winter to heat your home in Europe or heat your business. I would say that, what Putin's doing, I don't want to get off track here, but I think he's trying to cement his legacy because he's about 70 years old, and I'm not sure how much longer he will serve. But his legacy is he's trying to reassemble parts of the Soviet Union. And the big thing, Eastern Ukraine, which they invaded last night, has a lot of factories, truck factories, things like that. And, Ukraine exports generally a lot of wheat and corn. And so Russia's light on food, they could use that food. And so I think he's eventually just trying to put the pieces together to cement his legacy at the end of the day. And it's all about him and the oligarchs. He doesn't really care what happens on the ground. But this is not the Cold War Russia. They have T-72 tanks that are 50 years old. This is a country with a GDP the size of Texas.
A couple more questions, another pivot. This is around leading indicators that you think are key, maybe your favorite one or two for senior financial executives to look at. There's so many. If you had to point us to one or two, where do you think we should be looking?
Well, I think generally the one I look at the most is ISM manufacturing. And this is an index when it's below 50, manufacturing is contracting. When it's above 50, manufacturing is expanding. There's also an ISM services and a market manufacturing and market services. These are generally give you good health in the economy. We had this morning had a Richmond Fed index came in much lighter than a manufacturing index came in much lighter than expected. I think you're going to see a slowdown in some manufacturing because of this inventory build, which I think is happening, but it's not really evident yet to everybody. But I think those really give you a good insight into the health of the economy, whether or not the economy is really expanding or contracting. And I think we're right on the precipice, as I said. I think these inflation numbers will roll over probably by April or May, and I think you'll see those numbers roll over. And as I said, I think growth slows dramatically, which helps the Fed do its work.
Mac, any companies or industries that tend to benefit from this environment that you're forecasting? Maybe we're in it and we can get excited, or maybe we can invest in. Any thoughts of industries in the past or companies in the past that have done really well in the environment you're forecasting?
Well, I would say companies with pricing power. And typically those are luxury, more like you could look at an Estee Lauder or something like that. Some company that's passing along higher prices now due to inflation, but at the end of the day, they can hold the higher prices as their costs come down.
And then a question, I know as a parent of two teenagers and one in college, I'm always interested in emerging majors or trade skills. Any thoughts about if you're trying to, as you maybe speak to young people to equip themselves for the future economy with skills and education? Any emerging particular sectors of employment, or maybe degrees or skills that you see as really key to equip yourself for the future?
I don't know if I can really answer that. I think a lot of these, I've got two working age children, and I tell them to go to the office because they have to be around their peers and commingle with their peers and share ideas with their peers to further their professional development, whether within that company or another company. I think that the balance people achieve I don't really have an idea on majors. The balance people achieved is great, but you've got to go to work and work with your peers and work with senior management and understand their view of the world and share your ideas. But I think you've got to participate that way. And a lot of people, I think I'm answering the question differently, but a lot of people they just want to stay at home. They don't want to go to work.
And a last question.
All right, sorry.
Oh, I was one more question on the inflation slide. If you could, if you know where it is, we can look at it because I don't remember seeing this, but the question is around the inflation forecast in the out year, the last year, 2023, 2.3% seems low. What are your thoughts on the potential upside of that inflation forecast for 2023?
Well, the Fed has PC at 2.3%. They have their core PC inflation at 2.3%. So I'm right on the Fed at that point. But I think as I said, the combination of slowing economy, and I think eventually, probably by late this year, you'll see oil prices slowing down. And if you had a diplomatic solution to Ukraine, you'd probably see oil prices drop $5 to $10 a barrel. But let me say something about these numbers real quick. When you have these PPI numbers, energy is, you include them and you can look at them without food and energy, but food is energy. But the PPI numbers flow to the CPI numbers and the PCE numbers. So if you have a high CPI number like we had in January, this 9.7%, that means you're going to have a high CPI number the following month because they're producer, and then you go producer to consumer. So, I think that, as I said, it's going to take a couple months, 3 or 4 months to really get these numbers to roll over a little bit.
Well, Mac, this was fantastic. I've never seen anybody cover as many questions as you did as quickly. I thoroughly enjoyed this. I am going to send out a copy of this presentation to all members, and then I'm also going to send a link. There's some great resources on the Pinnacle Financial Partners website, white papers and reports. They put out an amazing amount of really fantastic equipment and information. So I'm going to send a link to that so folks can pull these resources if they don't already subscribe. So thank you very much, Mac.
All right,
I really enjoyed it. Everybody have a great day.